Basics of derivatives market. We will discuss following topics. 1. Derivatives basics. 2. Types of derivatives like future, forwards, options, and swaps. 3. Economic function of derivative market. 4. Details of forward contracts like features of forward and forward pricing. 5. Details for future contracts like future standardization and future pricing. What is derivative? A derivative is an instrument whose value is derived from the value of one or more underlying, which can be commodities, precious metals, currency, bonds, stocks, or stocks indices, and many more. The value is influenced by the features of the derivative contract, which may include the timing of the contract fulfillment, the value of the underlying instrument, and other factors such as volatility. Derivatives are widely used to speculate on future price expectations, or to reduce a portfolio risk of underlying asset. For example, commodity derivatives are used by farmers and millers to provide a degree of insurance. The farmer enters the contract to lock in an acceptable price, which is his production cost plus profit for the commodity. And the miller enters the contract to lock in a guaranteed supply of the commodity. Although both the farmer and the miller have reduced risk by hedging, both remain exposed to the risks that prices will change. Types of derivatives. Derivatives are classified mainly in 4 types: forwards, futures, options, and swaps. Derivatives can also be classified as the way an instrument is traded. Exchange traded, for example, futures and options, these are standardized and less risky instruments. Over-the-counter or OTC, for example, forward contracts and swap agreements, these are customized but more risky as counterparties are involved. Types of derivatives contracts. The table shows various types of derivative contracts. Underlying assets like equity, commodity, interest rate, credit and FX have various exchange-traded as well as OTC derivatives. Exchange-traded futures like index and stock futures, commodity futures, interest rate futures linked LIBOR, bond futures and currency futures. Exchange-traded options like stock and index options, commodity options, interest rate options, options on bond futures, and currency options. OTC swaps like equity swaps, commodity swaps, interest rate swaps, IRS, credit default swaps, CDS, and currency swaps. OTC forwards like equity forwards, commodity forwards, forward rate agreements, FRAs, and currency forwards. OTC options like long-term stock options or warrants, commodity OTC options, interest rate caps and floors, collars, swaptions, options on credit default swaps, and currency options. Economic function of derivative market. Prices in an organized derivatives market reflect the perception of the market participants about the future and lead the prices of underlying to the perceived future level. Thus, derivatives help in discovery of future as well as current prices of the underlying assets. The derivatives market helps to transfer risks from those who have them but do not like them to those who have an appetite for them. Derivatives, due to their inherent nature, are linked to the underlying cash markets. With the introduction of derivatives, the underlying market witnesses higher trading volumes. Speculative trades shift to a more controlled environment in derivatives market. An important incidental benefit that flows from derivatives trading is that it acts as a catalyst for new entrepreneurial activity.